From my office window, Melbourne appears perfectly normal. The skyline stands unchallenged, trains trace their predictable routes, and the morning rhythm of commuters with coffee cups remains unbroken. It is a portrait of a functioning, prosperous city. Yet, a week ago, when I opened the latest banking and property data files, what I saw made my hands go cold. Beneath this surface of normalcy, something fundamental is breaking. Melbourne is not experiencing a mere market correction. What is underway is a controlled implosion, and the families caught within it are discovering, too late, that the Australian dream they bought into was constructed on numerical foundations that could never hold. The evidence is stark and alarming. Over 400,000 Victorian households are now officially classified as being in mortgage stress. This represents 1 in every 4 homeowners in the state. We are not talking about speculative investors here. These are teachers, nurses, electricians, the everyday Australians who were consistently told that buying property was the safest, most prudent financial decision of their lives. Today, they are spending more than 30% of their pre-tax income just to keep a roof over their heads, and that percentage is climbing. Having tracked housing markets across the nation for years, I have never witnessed stress indicators accelerate with such velocity in a single region. Melbourne's crisis is defined not only by its scale but by its terrifying speed. Mortgage arrears have soared by over 40% in just 12 months. This isn't a slow drift into difficulty, it's a cliff edge, and thousands of families have already stepped off it, unaware that the ground beneath them had vanished. The shock of 13 rate rises, the primary catalyst, is no secret. The Reserve Bank of Australia (RBA) raised the cash rate 13 consecutive times between 2022 and 2024, the most aggressive monetary policy tightening cycle this country has witnessed in over 30 years. Melbourne, with its extraordinarily high property prices and correspondingly stretched household debt, absorbed every single hike like a direct blow to the chest. The numbers are brutal. The average mortgage rate leaped from around 2.2% to approximately 6.4% in under 2 years. On a $700,000 loan close to the Melbourne average, that translates to an asterisk extra $1,500 per month asterisk vanishing from household budgets permanently. A conversation with a financial counselor in Footscray last month left a mark that still weighs heavily. She told me the families now coming through her door defy the old stereotypes. They are not unemployed, nor are they reckless borrowers. They are dual-income households earning what was once considered a comfortable living, between $100,000 and $180,000 a year. And they are drowning. When your mortgage payment leaps by thousands, your electricity bill is up 26%, and your weekly grocery shop costs 10% more than it did 3 years ago, there is simply nowhere left to cut. You are not budgeting, you are bleeding out in slow motion. Crucially, this is not a temporary squeeze. Even if the RBA were to cut rates tomorrow, an eventuality no one forecasts, the damage is already entrenched. Australia's household savings ratio has collapsed from a pandemic high of 15% to below 3% today. That crucial financial buffer, the emergency fund that was meant to shield families from shocks, is gone. It has been entirely consumed by the rising cost of living. When the next economic shock arrives, and it will, there will be nothing left to absorb the impact. A citywide decline, the property market itself is now mirroring this financial distress in a way almost unprecedented for an Australian capital. CoreLogic data reveals that in the third quarter of 2024, a staggering 79.1% of Melbourne suburbs recorded price declines. Not some, not half, nearly 80% of the entire city moving downwards in unison. When such a vast majority of markets move in the same direction simultaneously, you are not observing a healthy correction. You are watching a structure come apart. Median values in Melbourne are down almost 7% from their March 2022 peak, the steepest decline of any Australian capital, and the pace is accelerating. An annual decline of 3% in 2024 might sound manageable until you recall that Melbourne property prices inflated 65% faster than household incomes over the preceding decade. The mathematics was already broken, the rate rises simply exposed the fissure. However, what truly keeps me awake at night is the chilling realization that Melbourne is not an isolated event. It is the canary in the coal mine, an early warning system for what is poised to sweep across every major Australian capital city. I know this because I have examined the debt numbers in Sydney and they are worse. Much worse. Sydney's household debt-to-income ratio sits at a vertigo-inducing 13.4. Melbourne's, by comparison, is 9.8. Let that disparity sink in. If Melbourne is buckling under a debt load of nearly 10 times annual income, what conceivable chance does Sydney have, where households are carrying 13 times their annual income in mortgage debt? The answer is none. Sydney does not have a chance, it has a countdown timer. Melbourne's distress is the sound of that clock ticking loudly and urgently. The contagion is already here, the pattern of contagion is already visible. Brisbane, whose property prices surged 65% between 2020 and 2023 on a wave of interstate migration, is next in line. Those buyers borrowed at their maximum capacity during the lowest interest rates in history. Now, as those mortgages reset at double or triple their original cost, Brisbane's outer suburbs are displaying the same stress patterns: rising arrears, climbing listings, falling prices that Melbourne exhibited 12 months ago. The sequence is identical, merely delayed by a few quarters. This is how contagion works in modern property markets. It does not arrive with sirens and headlines. It migrates quietly from one city to the next as the same structural problems, exorbitant debt, normalizing interest rates, and stagnant wages play out on slightly different timelines. Melbourne went first because its market was marginally more over-leveraged and its fixed-rate mortgages expired a little earlier. Sydney and Brisbane are on the exact same path, they are just a few steps behind. To anyone in Sydney watching this unfold, hear this clearly. If Melbourne is breaking under this interest rate burden and your city carries debt loads 35% higher, what makes you think Sydney will survive what Melbourne could not? The numbers are impartial. They do not care about harbor views or global city status. Math is math. The median house price in Sydney is $1.6 million against a median household income of around $95,000, a ratio of nearly 17:1. To sustainably afford that house at current rates, a household would need an income of at least $380,000. The gap between what people earn and what they owe isn't a challenge, it's a mathematical impossibility. Internal bank data shows payment fatigue, a new, devastating term in Australian lending, spreading through Sydney's western suburbs like Campbelltown, Liverpool, and Blacktown, where arrears rates are already double the national average. The mechanics of the meltdown, the mechanics of Melbourne's decline, provide a blueprint for what follows elsewhere. Listing data shows 30% more properties on the market compared to the 5-year average. Sellers aren't waiting for spring or better conditions, they are listing because they have to and buyers know it. The word agents use most often now is motivated, a real estate euphemism for desperate. Meanwhile, the rental vacancy rate has jumped from 1.1% to 2% in a year, an 82% increase in available rentals as investors exit en masse. In the CBD, apartment vacancies hit 5.9%. For an investor facing empty units, they are covering mortgage, strata, and rates with no income, a financial bleed that forces sales, which in turn adds more downward pressure to prices. Perhaps the most alarming factor is that we are only at the beginning. The great wave of fixed-rate mortgage expiries is now hitting. Families who locked in rates of 2–3% in 2020–2021 are seeing their terms end. Their repayments aren't adjusting gently, they are doubling overnight. I have seen the statements. A monthly payment leaping from $3,200 to $5,800. An extra $2,600 every month is not tight, it is impossible for budgets already pared to the bone. Modeling from Digital Finance Analytics warns that nearly 40% of Victorian mortgage holders could be in stress by mid-2026 if rates hold steady, and that assumes steady employment. Any rise in unemployment would catapult that number far higher. Ground zero, the outer suburbs. To understand the human reality, you must look to the outer suburbs: Broadmeadows, Craigieburn, Pakenham. These are not affluent enclaves but working-class communities where dual full-time incomes were the entry ticket to homeownership. Postcode 3047 Broadmeadows has the highest proportion of households in arrears in the country. Postcode 3064 Craigieburn leads Victoria in late repayments. Postcode 3805 Nar Warren holds the highest total number of stressed households in Melbourne. These were the suburbs marketed as the gateway to the Australian dream. Developers built them, banks approved the loans, and agents sold the narrative of building equity and securing a future. What went unsaid was that equity evaporates when prices fall, and security is a mirage when your mortgage becomes unpayable. Compounding the crisis, construction quality in many newer estates is often poor. Reports of cracked foundations, water ingress, and faulty wiring are common, saddling families with repair bills in the tens of thousands, money they simply do not have. Add to this the transport poverty of the outer suburbs where a $15,000 annual commute bill further devours any financial flexibility. The collateral damage is spreading. Victoria accounts for a massive share of national construction insolvencies. As builders fail and developers shelve projects, thousands of tradies, suppliers, and subcontractors lose their jobs, sending unemployment ripples through communities already on the brink. The unavoidable truth: the Australian Prudential Regulation Authority, APRA, has quietly intensified its scrutiny of Victorian mortgage books, directing major banks to run stress tests simulating unemployment spikes and property value drops of up to 20%. Publicly, they call this routine. Privately, sources indicate they are preparing for something far more severe. A 20% decline crystallizes the ultimate trap: negative equity. Consider someone who bought a Melbourne property for $800,000 in 2021 with a 10% deposit, $80,000, borrowing $720,000. If that property's value falls 20% to $640,000, they now owe $80,000 more than their home is worth. They cannot sell without bringing a check to the settlement table. They cannot refinance. They are stuck, hemorrhaging money each month with no exit. Federal and state politicians speak of manageability and future supply, but supply takes years, and families facing foreclosure have weeks. The uncomfortable, unspoken truth is this: the modern Australian dream was not built on affordability. It was built on leverage. Cheap, abundant credit made it possible. Expensive credit is now taking it away. The people paying the price are not the architects of this system, they are the ones who trusted it. They believed the axioms property always goes up, Australia is different. It never is. A final warning: I am not an economist or a politician. I am someone who reads the data and listens to the stories of those living this crisis. What I see is a system consuming its own foundations. Melbourne is the proving ground for what happens when unprecedented household debt collides with normalized interest rates after a decade of artificial stimulus. The experiment is failing catastrophically. So I ask you directly, no matter which Australian city you call home, what percentage of your income goes to housing? If your fixed rate is expiring, have you calculated your new payment? Do you know what your property is worth today versus what you paid? Could you be in negative equity without even knowing? Melbourne is not an isolated failure. It is the first domino. Sydney, Brisbane, Perth, Adelaide, every city that rode the same debt-fueled boom stands in line behind it. The idea that property ownership is the bedrock of middle-class security is collapsing across the continent because the math never truly worked. We just pretended it did for long enough that an entire generation believed the lie. This is a warning: the bloodbath is not coming, it is already here. It is happening quietly, one family, one suburb, one heartbreaking story at a time, until the silence becomes impossible to ignore.